Hi, this is Tom Alexander with Alexander Trading. It is Sunday, June 27th, 2010, and I want to do a quick 5 or 10 minute analysis of the U.S. stock indices at this point in time. They're at a critical level, and I want to share with you our analysis. We do analysis based on auction market principles using the market profile graph as one of our tools. So our website, by the way, is www.alexandertrading.com. You can check out other information that we have that is free on that website. Now, the first thing I want to show you is a chart. These are weekly charts. This is the Dow, the S&P, the Nasdaq, and the Russell 2000. And if you notice the horizontal lines here, 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 and here, these are areas in these markets from where they really began the crash in 2008, and we are at a very similar position now, particularly in the S&P and the Dow. Uh, the Nasdaq has a very defined support level, and the Russell not as much. The Russell has been relatively strong, and it has sort of sawtoothed higher on the weekly charts. But if a scenario unfolds and we get some sort of a waterfall decline into next week, certainly it looks as if this level is going to be tested here. This is the most important level in the rally from the March 2009 lows. We had the furious rally this year from February into the April top. We've had a volatile decline that has tested the February low a couple of times, and we rallied last week, and then or the week before, and then we sort of cratered last week. So we're testing or appear to be ready to test these very, very important levels, the most important levels in our opinion, uh, of the entire rally off the 2009 low, and it appears to be setting up in a similar manner to that of the about this time 2 years ago in the summer of 2008. Now, I'm not going to predict what's going to happen. That's not what we do. We're traders. We don't predict. But you do need to be aware of the levels at which these markets are trading now. The other thing to note here too is that it's incredible how highly correlated the Dow, the S&P, the Nasdaq, and the Russell are. Most traders, especially stock index futures traders, have a favorite. They'll say, well, I just trade the S&P mini, or well, I just trade the Nasdaq, or I just trade the Russell, or I just trade the Dow, etc. Well, they are extremely highly correlated in terms of swings, in terms of making pivot highs and pivot lows. That's true not only on the scale that you see, which is a weekly chart, but it's true down to the very small time frames, and I'm going to show you that in just a second. Now, there are some divergences here, and that is something else that's characteristic, and it's a heads up that something could be turning when they occur in this degree of time frame. But the important the important thing to note immediately is if when there's a substantial move, all of these indices are going to move in the same direction, and that is the message today. Now, I want to show you quickly. There are a couple other things I want to show you, but I want to show you how highly correlated these markets actually are. And we just did an entire one-day seminar on this that included this specific topic. Now, this is the Russell 2000 E-mini contract and the Dow, and the Nasdaq 100 mini contract. And this particular day happens to be the Fed day last Wednesday. I think it was June 23rd here, I'll tell you. Yeah, it was June 23rd. Now, this is a 1-minute bar chart, and basically what I've done is just overlaid the Nasdaq mini 1-minute chart on top of a Russell mini 1-minute chart. Now, most traders, if you ask them the question, which of the two indices do you think are least correlated intraday, uh, quite often you'll get, probably the majority of the time, you would get the Russell 2000 versus the Nasdaq 100, because you would think those would be very disparate indices and might have different personalities. And while there are short-term, very, very short-term intraday divergences between these two and among the other two, the S&P and the Dow. The more important thing to note is how incredibly correlated they are. Now, there are a couple of points here. They are extremely correlated in terms of price movement. The leverage involved in these is very different, and that's an opportunity for sophisticated traders that understand how to execute spreads, use options, etc., etc., and that's beyond the scope of what we're going to get into today. But I wanted to point this out because it is additional evidence that if the S&P does break this level that we're looking at from a market profile perspective, and I'm going to show you that now, then it's going to be, things could get really interesting. Now, this is a report that we publish every day for our subscribers, and in the report for tomorrow, for Monday, we've identified probably the most important market profile level in quite some time, and it is this high volume node right here that is 1078 to 1073. That level is critical for the foreseeable future, and certainly the next week. You want to make sure that you're trading on the price side of 1078, 1073. If price is above it, you want to be favoring longs. If price is below it, you want to be favoring shorts. That is in general. We are expecting volatility away from this area. It could be volatility in both directions, but you don't want to be caught with a position trade or a swing trade on the wrong side of 1078 to 1073. Of course, if you are an intraday trader, this opens up numerous intraday trading possibilities that just have to be covered in real time. That's something we'll certainly cover in our live trade room, but it's beyond the scope of what we're talking about now. The most important level below last week's 1065, 1062.75 buying tail is the 1034 level. That's actually I think it's actually the June low. So this is the level to keep an eye on for you traders next week. The other thing that fits with this is the breadth look. We look at breadth. Breadth basically is defined as New York Stock Exchange advancing issues minus declining issues, and we plot that as a graph. And here it is. It is neither overbought nor oversold. It's going to be one or the other very quickly next week. The market appears to be in a similar position from an internal technical perspective as it appears to be from a development structural perspective. That is, it's coiled up and you're going to get a sharp move. So this is something we're watching very closely. We feel that that next week is a very critical week, and the key is to be on the right side of this area of value, this high volume node at 1078 to 1073. This has been Tom Alexander, and we will see you again soon.